The first thing most people would do if World War III started tomorrow is open their brokerage app instead of checking on loved ones, because financial anxiety hijacks instincts and redirects them toward a portfolio that probably doesn't need help. Meanwhile, someone else is buying strategically, following patterns that have repeated in every war this country has fought. My name is Susan, and the history of war and money is counterintuitive. Ignore it, and the next crisis will cost you. The real obstacle isn't foreign governments or hedge funds, it's the financial media. They profit from your panic, amplifying fear, airing alarming experts, and pushing brokerage ads while you make emotionally driven trades. Meet John. He had $40,000 in index funds and a stable job, watched 3 hours of coverage when Russia invaded Ukraine in 2022, and sold everything by 9 a.m. Then meet Alice. Same portfolio, same morning, same news alerts. They read one data point. The S&P 500 had recovered from every major conflict since World War II in about 47 trading days, turned off the TV, and went to work. Everything that follows is the story of their money, and the gap between them will make you angry, not at them, but at the system that rewarded the wrong decision. Here's what media never lead with. Markets don't die in wars. They dip, panic, and then recover. The Dow gained 50% during World War II, 60% during Korea, 27% during Vietnam. The S&P 500 has posted positive one-year returns after most conflicts since 1945. It has survived world wars, nuclear standoffs, pandemics, and crises, basically acting like a cockroach in a suit. Wars pump money into economies through government spending on weapons, logistics, and infrastructure. That spending flows to publicly traded companies. The government becomes a massive customer, and earnings rise. Investors who lose are usually those who sell during panic and sit in cash, missing the recovery. John sold his $40,000 index fund at the bottom, missed the rebound, and paid taxes on the sale. By the time he re-entered, the best gains were gone. The news he trusted ran ads for investment platforms while stoking fear. Alice did nothing. She kept automatic investments running and let time work. Most people think crisis investing means buying gold, but that instinct is often the wrong timing and amount. Alice built her foundation first. 6 to 12 months of living expenses in a high-yield account, a money market fund, and $2,000 to $5,000 in physical cash at home. Physical cash isn't paranoia. It's a hedge against digital infrastructure failures, like when Russia was cut from SWIFT in 2022. Once the emergency fund is set, you can invest. Buffett warns that holding excess cash in wartime erodes value. Wartime inflation averages 4.5%. Step 2, gold, 10 to 15% of investable assets, but not as a panic play. Gold spikes with fear and often retraces afterward. The best time to buy is before the crisis hits headlines. Current gold strength comes from structural demand. Central banks bought over 1,000 tons annually starting in 2022 to diversify away from the dollar, not from fear. That move isn't over. The practical vehicle here is IAU or SG, both of which hold physical gold at near zero cost. If you want exposure without complexity, these are clean solutions. Alice used IAU because she already owned it before 2022 and watched it climb while John stayed in cash. Keep a small slice, about 5% of your gold allocation, in physical coins. Not for apocalypse scenarios, but for situations where digital systems are disrupted and tangible value matters. Step 3, defense. 10 to 15% allocation. This is one of the most consistent historical trades during wartime cycles, yet most investors avoid it because it feels uncomfortable. Profiting from defense manufacturing doesn't fit everyone's intuition. The data, however, is clear. Raytheon gained 37% after 9/11. A $10,000 basket of major defense contractors in 2001 grew to $97,000 by 2021. Lockheed Martin has returned over 1,200% since the start of the post-9/11 defense cycle. In 2022, while the S&P 500 dropped 18%, defense stocks outperformed by 28 percentage points. European defense equities have risen roughly 260% since 2022 as governments increase military spending. This isn't a short-term war trade. It reflects a structural, multi-year shift in global defense budgets. RTX alone holds over $200 billion in backlogged orders, work that would take years to fulfill even if conflicts ended today. Poland is spending over 4% of GDP on defense, double NATO targets. Germany launched a 100 billion euro defense fund in 2022, reversing decades of minimal spending. The EU as a whole continues record defense allocations year after year. For ETF exposure, XAR, Equal Weighted Defense ETF, is often cleaner than ITA because it avoids concentration risk in a few mega-cap names. XAR spreads exposure across the sector while still capturing growth. Alice bought XAR and saw gains before John even finished debating whether to re-enter the market. Step 4. Energy. 10 to 15% allocation. The war economy is a stimulus economy. Government spending flows straight into corporate earnings. Keep contributing automatically. Roth IRA. A downturn is the perfect time to contribute or convert. You buy tax-free growth at a discount and ignore it for months. John sold $40,000 in index funds on February 24th, 2022, sat in cash for 4 months, paid capital gains, and re-entered after energy and defense had already surged. 4 years later, his $40,000 grew to roughly $48,000. Alice, meanwhile, kept her $40,000 invested, added automatic contributions, and used tactical positions in XAR and XLE. Her portfolio is now about $91,000. Same starting point, same news, $43,000 difference. She didn't pick a magic stock. She bought fear at a discount while John panicked. When markets flash red, the unprepared open their apps, sell, feel briefly smart, and watch recovery from the sidelines. The prepared check their structure: cash, gold, defense, energy, staples, inflation protection, untouched index funds. Put the phone down and keep living. One of those approaches builds wealth, the other feeds the system designed to prevent it. The time to become the second person is now, not when the crisis hits. That's it for today. I'm Susan, and remember, don't panic when the markets shake. Stick to your plan, stay disciplined, and let your strategy do the work. If this helped you, hit subscribe and share it with anyone who needs to hear it. Keep calm, stay focused, and I'll see you in the next one.